Hey guys, it's Sasha. Yet another big IPO is happening right now today. Coinbase is about to go public as I'm making this video, and everyone is going crazy for it. That's all anyone wants to talk about. And yet I have no interest in jumping on the bandwagon whatsoever. And yet these IPOs that have been happening recently are getting everyone super excited. Every single investing channel out there talks about the next big upcoming IPO and whether people should invest and how much they should invest. But I have no interest in buying any of them pretty much. And I wanted to talk to you about why that is. Just before I do, a really brief disclaimer. I am not a financial advisor. I can't provide financial advice to you. This is purely an educational video. If you do need financial advice, please make sure you go and seek the help of a suitably qualified professional. Now, let me explain why a company typically goes through an IPO and what the recent surge in investing capital has meant for company valuations and my personal view based on my personal experience of being on the other side of these things. A typical startup will start out by getting funding through angel investors and the personal money of its founders, or some kind of combination of those things. After they eventually get going, they typically go through several rounds of funding to collect even more money while the business is not yet profitable, often before the product is even launched. But then even after the product launches, quite often in the first few years, it's not actually profitable because it needs economies of scale. And so during those few years, they continue collecting one funding round after another. Sometimes the company will then be bought by an early stage private equity company, and a few years down the line they might sell to a different private equity company that deals with the more mature businesses. In all of these paths, eventually there will come a time when the people who own the company, whoever it may be, the original investors, a private equity firm, or whatever other crowdfunding group of people, eventually they want to go and cash in on their investment and get their big payday. Now, early investors are really excited by the huge prospects when they're first putting the money in because the opportunity is so vast. But as time wears on, the size of that potential opportunity becomes smaller and smaller, and eventually those people looking for the big returns are not getting the sort of returns that they really want in order to continue investing in the business. And at that point, they need to go and materialize those profits so they can go and take them and invest them in the next thing coming up, or 100 of those things. Now, this is the opportunity for everybody who has invested in the business, and often the people who work there, who typically get a small number of shares as well, to go and get their big fat paycheck. Now, this is what happens when a company actually does decide to go through an IPO. First, you'll notice that the PR machine is going to go into massive overdrive. Specialist marketing firms get hired, executives go all over the media channels and talk up the prospects of their company. They'll say how amazing their technology is. They'll make stuff up in some cases, that has happened recently. And it's just going to be a whole load of trying to woo as many people as possible, trying to explain how great the company is to as many people as possible. You'll notice articles begin jumping around on every kind of news outlet out there. Everyone needs to become aware of this IPO that's coming up. And then we get to the valuation. You see, this is one big opportunity for the company to make really big money. The big opportunity for everyone who took the risk with the company by investing money early on to make as big a return as possible. So before this company goes and approaches an IPO, every single trick in the book to make the numbers look as good as possible is going to be employed. Huge marketing campaigns will start 24 or 18 months before, giving a massive push for new customer numbers to come on board. There'll be loads of loss-making promotional deals to make sure that those customers go and spend as much as possible, buying the services or the products or continuing to engage with them. Any spend or losses that can possibly be moved to the previous year or suspended and actually delayed until the following year after the IPO happens will be moved to make the numbers look as pristine, as good, and as strong in terms of future indicators as possible. Now, I've been involved in some of these projects personally, so I've kind of seen how it happens a little bit from the inside. It's a bit like putting your house on the market. The moment you have people coming around to view your house and potentially making those offers, everything has to be perfect. The rooms are freshly decorated, the beds are perfectly made, and the person selling will have spent hours tidying everything and making everything look great. They will probably spend money resurfacing the drive, replacing things in the garden, laying down a fresh lawn, because first impressions really, really matter. This isn't how the house is going to actually look like 3 years down the line after the person buys it, because they're not going to probably continue putting that amount of stuff into the house every single month. And the likelihood is, things are going to look the best for that house at that particular moment when the sale happens, better than they were before and probably better than they are going to be immediately after. Very often, companies go through an IPO when they're at their possible maximum peak, and that achieves the best possible valuation. Look at Deliveroo that went public recently. This is a really good example of what I'm talking about. They banked on an entire year of absolutely huge revenues because all the restaurants in all these different countries they operate were closed, and everyone was sitting at home and everyone was, well, using Deliveroo. They've already pretty much maxed the market share in some of their biggest markets in the developed countries. So at that very point, after all of these things aligned, they decided to go public. They had a huge valuation, but it proved way too optimistic, and the price has been falling sharply ever since. They went public just a few days ago, but now we have Coinbase, and I don't know what the price is going to do. It could go up, it could go down. I don't really care, because for me, the same thing is happening. Bitcoin is at an all-time high. It's been hitting $64,000 today as I'm recording this, which at the moment is really, really high. Transactions towards the end of 2020 and in Q1 2021, in terms of Bitcoin transactions, have skyrocketed, and the fees associated with them have gone up as well. And the last big price drop for Bitcoin that does happen every few years happened a mighty 3 years ago. So all the stars at the moment are aligned, and they have a huge $100 billion valuation. Could it grow in the future? Sure, it might do. It might do extremely well, but the volatility and the certainty around that is just not there for me. Do I think it is a good time to go and invest at the huge multiple that they're going to market with? I personally am really not sure. The other big contributing factor is the huge rise in the money floating around in the world of investing. In the last 12 to 24 months, a massive number of brand new investors have turned up to the world of investing for the very first time. Investing used to be something that only hedge funds and rich people used to be able to do. But now with apps like Robinhood, Webull, Trading212, Freetrade, and all the other ones all over the world, suddenly it is super easy to get into investing without having to pay huge fees and without having to have really fat wallets. And the masses have really turned up, many with very limited previous financial investing backgrounds, and many kind of lured by the potential, by the massive things that have been happening. You only have to look at the last few months with the whole GameStop saga and all the other shenanigans that have been going on. The huge bull market of 2020 really didn't help. Shares in the stock market grew by one of the highest amounts ever. And suddenly anyone who put their money in the market at that point was getting ridiculous returns, and the snowball effect has really come around. Now suddenly everyone who is doing any kind of investing is the next Warren Buffett, because they're making so much money and absolutely everything is going to the moon. Now, does this mean that every company that is going public is not worth investing in? No. I actually have invested in 2 IPOs in the last 12 months, although with very, very small amounts of money. They actually happened on the same day, incidentally. It was Palantir and Asana. They both came out with valuations that I felt were pretty good based on my estimates of the companies, and both have actually done pretty well for me since then. So yes, it is possible to go and find good companies that are doing IPOs to invest in, but it can be a massive minefield. And for the vast majority, I just steer well clear, because very often the prices bake in so much speculation, so much hype, that I just really don't get excited by them as a long-term investor whatsoever. I hope you guys found this useful. If you have, don't forget to hit the like button for the YouTube algorithm so this video can reach more people. Thank you so much for watching. I really, really appreciate it. And as always, I'll see you guys later.